You now know you need to invest regularly as early as possible to take advantage of the power of compounding. But where exactly should you put your money? The S&P 500, often whispered among the wise, is akin to a golden compass pointing to prosperity. As we journey together through this narrative, you'll uncover how this mysterious index has shaped fortunes and why it might just be the best risk-adjusted investment in the entire world. Before we dive in, if you're curious about the game changers in my financial journey, check the description below. There's a list of personal finance books that have been my guiding stars. If any catch your eye, simply click on their links. Not only will you get a valuable resource, but you'll also be giving a boost to this channel. Also, don't forget to like and subscribe for more personal finance content. What exactly is the S&P 500? The S&P 500 sounds fancy, right? But at its core, it's pretty straightforward. In the world of finance, the S&P 500 is a bit like the most popular marketplace, but instead of fruits, veggies, or crafts, it's packed with companies. 500 of them, to be precise. Big ones. Names you'd recognize from everyday life, from the sneakers you wear to the phone in your pocket. Now, why 500? It's not just a random number. It's a selection of 500 top-performing companies in the US, ranging from tech giants to energy behemoths. These are the companies that have a significant say in how the American economy pulses. When they're doing well, they have the power to lift the spirits and wallets of countless people. Some of the companies you may recognize include Apple, Microsoft, Amazon, Nvidia, Google, and Tesla. Purchasing the S&P 500 means you are purchasing a small ownership share of all these companies. This means you will essentially own a portion of the company's future profits. The S&P stands for Standard & Poor's, the name of the company that put this index together. Think of them as the organizers of our financial marketplace, making sure everything runs smoothly. But why should we care about this index? Because, in a way, it's like the heartbeat of America's economy. If you want to know how healthy the business side of America is, the S&P 500 gives you a clear picture. It's like a thermostat for the nation's financial health. Why do investors love it? Step into the world of investing and you'll quickly find everyone has their favorites. Some people have a soft spot for real estate, while others might be drawn to gold or art. But there's one name that keeps popping up, especially among those who've tasted success in the investing game: the S&P 500. Let's explore why this index is like a magnet, attracting investors from all walks of life. 1. Diversification. Everyone loves choices, right? Well, the S&P 500 is the king of choices in the stock world. Investing here means you're spreading your money across 500 of the absolute best companies in America. This spread-out approach reduces risk, and who doesn't like a safety net when navigating the financial high wire? When you buy the S&P 500, you are essentially getting the most qualified and talented CEOs and workers like Elon Musk, Jeff Bezos, and Tim Cook to work for you and generate as much profit for you. 2. History of growth. Over its long period, it has shown a remarkable ability to grow. Sure, there are ups and downs, it's a market after all, but since inception, the S&P has returned 11.88% annualized. That means it's compounded at almost 12% for over 65 years. If that is hard to comprehend, if you had invested $1,000 65 years ago, you would have a whopping $1.46 million today. Investors love consistency, and the S&P 500 delivers that and high returns, making it a blockbuster in the financial cinema. 3. Simplicity. The world of stocks can be, well, a tad overwhelming. So many companies, so much news, charts, numbers, it's easy to get lost. But the S&P 500 offers a shortcut. Instead of trying to pick one winner from thousands of companies, why not just bet on the top 500? It's like choosing the best of the best without breaking a sweat. Besides, research shows that the S&P 500 outperforms most individual stocks and the vast majority of active managers over a long period of time. Warren Buffett, widely considered to be the best investor of all time, has repeatedly recommended that buying the S&P 500 is the best investment the vast majority of people could ever make. He even recommended people buy the S&P 500 over shares of his own company, Berkshire Hathaway. 4. Accessibility for all. Now, you might be thinking that getting into this elite club requires a hefty price. But here's the fun part. You don't need to be a millionaire to start. Many platforms allow you to invest small amounts. So, big or small, there's room for everyone at the S&P 500 party. My preferred choice is the Vanguard 500 Index ETF with ticker symbol VOO because of its low fee structure. While one share of VOO costs $419 as of today, many brokerages like M1 Finance allow you to buy partial shares, meaning you can get started with as little as $1. If you'd like to open up an M1 Finance account, feel free to use the referral link in the description below. You could not only earn $100 free to invest, but I will also get a small commission which would help me continue to make videos like this. 5. A reflection of progress. The companies in the S&P 500 aren't static. The list evolves, adding emerging stars and letting go of those losing their spark. This means investors are always getting a slice of modern and relevant businesses. It's a dynamic playlist of financial hits, always updating, ensuring that the tunes or returns are never outdated, and no work is needed on your end. You are paying S&P with the small fee to reorganize the companies. 6. U.S. Exceptionalism. While many have historically talked about the imminent demise of the United States, none have been right. You will always have doomers who say the U.S. is now on the decline. However, this is far from the truth, especially if you consider the lack of any remote competition from other countries. Some may say China is a contender, but as described in detail in Peter Zeihan's book, The End of the World is Just Beginning, China has a serious demographic problem, meaning the population is in steep decline, and without more humans, China loses any edge it may have had. If you'd like to get your copy of Peter Zeihan's book, see the description below. All this to say, the American economy has been and will likely be the best place to invest your money over the long run. Warren Buffett also agrees with this sentiment. The U.S. economy to this day has more positives going for it than any other economy. The country leads the world in terms of technology and innovation, creating a dynamic and competitive business environment that attracts foreign investment and fuels economic growth. This is further bolstered by the U.S.'s robust legal and regulatory framework, contributing to economic stability. Moreover, the U.S. dollar's status as the world's primary reserve currency aids in maintaining economic stability and attracting investment. This, along with countless other reasons, are why 65% of the biggest companies in the world are American. The magic of compound interest. Investing in the S&P 500 can be the most effective way to take advantage of the power of compounding, a process where the returns on an investment generate their own returns over time. You may garner larger returns with real estate, but you would have to use leverage, i.e. your mortgage, which comes with greater risk. You may get safer returns with a certificate of deposit or bonds, but the returns pale in comparison to the S&P. The S&P 500 is the best risk-adjusted investment available, in my opinion. When you invest in the S&P 500, any returns you receive in the form of capital gains or dividends can be reinvested, acquiring more shares in the process. Here's how compounding works in this context. 1. Capital gains. As the companies in the S&P 500 grow and increase in value, so does the value of your investment. When these gains are reinvested, they can generate further gains, leading to a compounding effect over time. 2. Dividends. Many companies in the S&P 500 pay dividends. When these dividends are reinvested, they buy additional shares that can also earn dividends in the future, contributing to the compounding effect. The key to compounding is time. The longer your investment is held, the greater the potential for compounding returns. This makes S&P 500 investments particularly suitable for long-term investment goals. How to get started. So, you've learned about the glitz and glamour of the S&P 500, been charmed by the magic of compound interest, and now you're thinking, how do I join this party? Well, pull up a chair, because getting started is easier than you might think. 1. Dive into research. Start by reading up a bit more about the S&P 500. While we've touched on its allure, it's always good to get a fuller picture. Websites, books, even podcasts, there's a ton of resources out there. Knowledge is your ticket, and there's no such thing as being over-prepared for this journey. 2. Set your goals. What's your aim? Maybe you're saving for a new car, a house, or even your retirement. Knowing your destination will help you plan the route. After all, a ship without a direction can get lost at sea, but with a map and compass, it'll find its way to treasure. 3. Find your platform. These days, there are countless platforms where you can invest in the S&P 500. Think of them as the gateways to the grand ballroom. Some are fancy with bells and whistles, while others are straightforward and to the point. Choose one that fits your style and budget. I personally prefer M1 Finance due to the simplicity and flexibility it offers. You can join too, using the link in the description. 4. Decide on a budget. How much are you willing to invest? You don't need a mountain of gold. Even a handful of coins can get the ball rolling. Decide on an amount you're comfortable with. Whether it's a one-time investment or a regular monthly contribution, every bit helps. It's like building a house, brick by brick. My preference is deciding on a percentage of my income and investing it every month, no matter what. 5. Stay consistent. Once you've started, stick with it. Markets will rise and markets will fall. It's their nature. But remember the magic of compound interest? Give it time. It's like planting a tree. At first, you might just see a tiny sapling, but with time and patience, it can grow into a mighty oak. 6. Review and adjust. Life isn't static. It dances, twists, and turns. Your goals might shift, and that's okay. Regularly review your investment. Maybe you want to invest more, or perhaps you want to withdraw a bit. It's your journey after all. Just ensure you're not selling out of fear. Isn't it fascinating how something as simple as the S&P 500 can open doors to a prosperous future? If you'd like to learn more about your investment options, click on the suggested video on the screen. Until next time, keep calm and compound on.